Hey, Fools, we had a couple oil juniors released within the last week, and you got some great insight into the Williston Basin and the Utica from them. So what exactly did you notice out of these two, Joel?
Yeah, definitely. When you're looking for oil juniors, it's all about growth. Obviously, these companies are taking on a lot of debt to increase their production. So if you start seeing their production numbers go down or not hitting a lot of their estimates, it hurts them very bad. Halcon came out and basically they barely missed on their adjusted EPS, but their revenue and EBITDA were higher. This company I've always liked because they have good management and they've been increasing their liquids by so much. And if you look at their net production year over year, it came in at 646%, obviously huge. A lot of that is from a number of acquisitions they've had as well. So when you look at them, this is a company that you want to see that production keep going that way. And then on an adjusted basis, their total operating costs were down 42%, so they're getting more efficient, which is very solid. Another company that had earnings, Kodiak Oil Gas, this is a company also missed EPS, adjusted EPS slightly, and beat on revenue. This company is very oil heavy. They're only in the Williston Basin, 94% oil production, or what they produce is 94% oil, which is very solid. And this is one that for years you've seen such large growth. From 2011 to 2012, you saw 270% increase in production. You're looking at, depending on what they hit at the end of this year, somewhere between 100 to 130% production growth as well. However, when you look at them, drilling in the Bakken is a little bit more expensive than having a wider portfolio like Halcon. So, they've made some adjustments and went into the pad drilling and lowered their costs and their drill times. However, they're still about $10 million per well, which is pretty high. So that's one thing that when you look at this company, you're not really sure about. Another company that actually has earnings today after the market is Sandridge Energy. This is a company that I'm really looking forward to seeing what they do with their production. Obviously they're a little bit more natural gas than oil, but they're also the leading producer in the Mississippian, and they're getting their well costs close to that $3 million. They want to end the year at a $3 million well cost or below. So that's something I'm really looking for them to see if they can increase their capital efficiency like they've been doing and also lower their costs, similar to what Chesapeake did, and Chesapeake had a great quarter.
Yeah, it will certainly be interesting to see, especially given that there's $7 million difference between that Mississippian line and what you're seeing happen in the Williston. So obviously interesting compare and contrast here between some of these smaller companies we're looking at. But you've got some worries moving forward with this growing oil production.
Yeah, definitely. When you look at Halcon and Kodiak Oil and Gas, when they're outspending their capital or their cash flows from operations by such a large mark, they're really going to the debt market, which is worrisome. So if they don't hit these production numbers, how are they going to pay this off in the future? So, when you look at them, you want to look at their debt maturities. Halcon, the majority of their payments are going to be coming due in 2017 and 2018. And one thing that I like about these companies is they do have smart management and they will be able to find a way to finance this. However, they might have to pay higher rates.
Right.
One thing that I am worried about with both of these companies is if they're really gearing their companies to sell in the near future. If you've seen Halcon, Floyd Wilson, the CEO for that company, has had a history of turning around companies and selling them. And then Kodiak Oil and Gas, last year there's a number of articles that were showing that they were looking to go out and price their assets for a sale. So if they're looking for a quick turnaround and sale and not really focusing on the balance sheet as much, that could really hurt them in the long term. If they don't find a great deal to put together, then they'll have to take on that higher debt load, which is worrisome.
Certainly something for investors to look at is the incentive of management. What exactly are they in the business for? And if it is to sell, hopefully you get a good buyout price. But if not, if they don't get an acquisition taken care of, they could be in a pretty hurtful spot as far as the balance sheet. So we'll continue to monitor that as we move forward on Fool.com. Keep fooling on.